I'm gonna give you my thoughts on the real estate market in 2023 and beyond. I'm going to go over 5 reasons why what's happening now and in 2023 is not anything like what happened in 2008. The number one reason why the pullback or the fender bender of 2022 and 23 is nothing like 2008 is there were millions and millions of bad loans given out in 2008 and leading up to 2008. I don't know if you've seen the movie The Big Short. I've watched it a few times. It was based on a lot of factual data, and I was remembering a scene where Schmidt, the guy from New Girl, was selling houses to strippers that could not afford them. I mean, strippers, I think most of them do pretty well, especially if they're a good stripper.
So do applicants ever get rejected? Even if they have no money?
No income, no job. You know, I just leave the income section blank. These people just want homes, you know, and they go with the flow.
The scene was the stripper had 5 houses and a condo on an adjustable rate mortgage. They didn't even give accurate data on the borrower, meaning a bank and then eventually big government bonds and funds would buy loans stacked together full of really, really unqualified borrowers. Meaning if somebody wanted to buy a $500,000 house and they made about $45,000 a year, they would literally white out $45,000 a year and say they made $150,000 a year or whatever made that loan look more appetizing. It was the definition of fool's gold. Flash forward to today, obviously 2008 caused a lot of issues locally, nationally, internationally, globally, maybe even out in Mars, I don't know, but it caused a lot of really, really big issues and the ripple effects were extremely profound. So we fixed that. Going forward, there was a ton of laws and regulations and banks went under and a lot of things have been put into place. I actually recently talked to the owner of a local bank here in St. Louis that we do quite a bit of business with, and he said the loans that they've given out to people, mainly we're talking residential here because that's what kind of causes crashes is the residential side because it makes up 90-something% of transactions. But he said that the borrowers that have gotten properties and houses in the past several years are all extremely qualified. He's like, they're the type of borrowers that do not default. They just won't. So the loans that have been given out recently are good loans in majority to people that can afford them. So that is polar opposite of 2008. The second reason, and as I tell you about this one and the following 3, we're going to get a little bit deeper. Back in 2005, 6, 7, and 8, investing in residential properties as an investment strategy and as an actual place to put your investment money and as an asset class was not a thing. There was not Wall Street money or hedge fund money in the game. It just simply wasn't an investment. It wasn't something that a lot of money was behind. Recently in the news, JP Morgan is buying, I think, $1 billion worth of real estate or some crazy number like that. BlackRock has bought hundreds of millions, if not billions of dollars of houses over the past couple years. There's REITs, and there's a lot of Wall Street money investing in the single family real estate market because it's such a good asset class. It's something that produces cash flow, you get appreciation on, you get tax benefits. I mean, the benefits of investing in real estate, hopefully you understand them. If not, make sure you're following this channel and me on all my social media platforms because I hammer that home. So how is that different than 08 besides just the fact that people weren't investing in real estate and now they are? Well, what that does is it puts a floor on house prices. A crash by definition is when house prices go down quickly. People get underwater and they get houses they can't afford, they lose their jobs, the house values go down rapidly, just a lot of bad things happen because the house prices and the values go down so quickly. The floor is not down here, the floor is more like probably up here somewhere, if that makes sense. So as price dips, which they are now and they will a little bit probably going forward before they go back up, they're gonna hit the floor. The floor is not near as low, so the fallback and the dip in values is not going to be as drastic for that reason. Number 3 is the entire nation / world / social media. Everybody is staring directly in the lens of the housing market right now. Back in 2007 and 8 when the last crash happened, it caught people off guard. That was part of the reason why it was so bad because nobody saw it coming. Of course, some people saw it coming if you saw The Big Short and other videos and other pieces and articles written on back then. So the fact that it caught so many people off guard, they weren't prepared, they didn't have other investments, they didn't have equity, they didn't have line of credits, they didn't have all of this stuff set up to withstand a price drop. That was a big reason why it was a crash and why it caught so many people off guard and why it was so bad. Nobody was on social media, nobody saw it coming. Now, Everybody's on social media, everybody sees it coming. Now that doesn't mean that house prices aren't gonna dip and we're not, going to have some type of a pullback, but it does mean that people are watching it. They're not gonna be caught off guard and they are more prepared. Number 4 is something that almost nobody's talking about. So back in 2005, 6, and 7, as house prices were going up before the huge dip, a lot of people were transacting and buying houses. I looked at some data and I saw a few different reports, but in general, around 6.5 to 7 million houses were being sold every year leading up to 2007. So maybe 2005, 2006, 2007, around that time frame, a lot of people were underwater because they bought at the price increases and the higher prices. And number 5, which is my favorite, is perspective, perspective, perspective. Looking back, look at the chart that's gonna pop up in front of me, or is right now. Looking back at the data, 2008 to 2010, it doesn't look that scary. I get that it was, I was in college at the time, but I've talked to a lot of people that went through it and looked at a lot of data. If you take a step back and have some perspective, that dip wasn't really that bad. And within a couple years, house prices were right where they were in 2007. It didn't take forever. It didn't take 10 years to get back. It was a quick little blip in the radar. Now it was a drastic blip, but it wasn't anything that was like a 5-year dip or something that was extremely scary looking back. And also, it's never a bad time to buy a good deal. I've talked to a ton of people that bought houses and made investments in 2005, 2006, 2007, but they bought them the right way. They bought them with equity. They bought them with cash flow. They had reserves and they still own those assets today and they're worth double what they were at the last peak. It's never a bad time to buy a good investment. You just have to know how to buy it, where to buy it, and how to manage the investment and manage the property after the fact. If you do that, you'll always be glad you bought real estate. All right, here's my prediction, and then I'm gonna give you a chance to work with me at a little bit deeper level. I think the beginning of 2023, we're gonna see a little bit more of a interest rate increase. They've actually gone down recently. As I'm recording this video right now in mid-December, interest rates have already dropped. I mean, shoot, I think they're below 6.5 right now. But I could see another increase end of this year, beginning of next year. Inflation reports, I think, are gonna be a little bit dicey, but I think most markets will see a little more normalcy. You'll get back to, house prices not maybe falling, maybe slightly falling or remaining pretty steady. And in some markets like the Midwest and the South and the Southeast, actually prices may be starting to go back up a little bit. We're not talking 20% increases. That's not normal. I'm talking about 3, 2, 4, 5% increases throughout the next year in a lot of markets. I could see us ending 2023 at interest rates, which doesn't tell the whole story, but it tells a lot of the story, at least people's perspective on the market. I could see us getting back into the, low 6s, high 5s by then. And this data is based on my observations and talking to a lot of people that know a lot more than I do about real estate, as well as mortgage rates and interest rates. So I could see that happening. And I think by the beginning of 2024, I really do. I think interest rates are going to be back in the 5s for sure. High 4s, probably not, maybe. I've heard some people predicting 4.75 by spring of 2024. I'm not saying that's gonna happen, but I've heard that number thrown out there. So I could see things starting to get back to a lot more normal and still having seasonal ups and downs and still having some markets be too hot, but in general getting back to a more realistic real estate market, because most people predict a crash or a boom or the worst case scenario, best case scenario, and it's usually somewhere in between. If you want a deeper level with me and a deeper investment knowledge and kind of maybe being even further ahead of the curve than most people, I do have a mentorship. Now this again is no pitch for that. I'm not even going to tell you how to sign up, but if you do have interest in that mentorship, go to www.freerentalwebinar.com. The link is in the description below this video, and just hop on a call with my team to go over the options and make sure it's a good fit for you, because it's not a good fit for everybody. There's one-on-one coaching calls, there's weekly group coaching calls, there's a closed Facebook group, there's almost $200 million in real estate owned in that group, almost 1,000 students in that group now, just happened all in 2022. So it is a fast growing, extremely powerful community that if you want to change your life and create financial freedom and control your future, is probably something you want to get on board with, or at least have the call about. Hope you enjoyed this video. If you did, make sure to check out my other videos over here where I talk about how to invest in real estate the right way, doing things the right way with integrity and creating wealth. See you on the next one.